There's a lot of people who are against shorts, primarily long. I love a big short position against something I'm in favor of. That's a position that has to be bought. In some investments, by the way, silver related, often Pan American Silver and the Silver Standard in particular, we delivered quasi-religious experiences to the short community. And I suspect that if people end up being too short PSLV, that they could experience just exactly that kind of religious experience. There's nothing in the world worse than being caught on the wrong side of a short trap.
Let's get their questions answered, if you would. There's a question on Basel III relative to the price of gold. And I guess this is from Nitro Burp 2694. He's probably asking about the regulation changes that made gold a tier one asset for central banks, et cetera. Can you talk to us about if you think that the price of gold and accumulation, physical accumulation by central banks around the world has been impacting the price and what you see forward for that?
I don't think that the Basel III Accords were particularly important to the increase in the price of gold, because the Basel III banking accords primarily affected private sector banks. It being gold was made a tier one asset for banks like Barclays, Bank of America, Citicorp, Daiichi Kangyo, those types of global banks. The buyers have been foreign central banks. I do believe that the Basel III Accords will be important to the gold price going forward when the private sector steps up to the extent that the public sector has in the gold trade. Other aspects of the Basel III banking accord probably indirectly will benefit gold too, in the sense that although rules around gold were made less restrictive, there were other rules around the characterization of bank reserves. And in particular, the differentiation in reserves against debt instruments that were held for sale versus held to maturity. Accords that allow banks to extend and pretend around time losses in their portfolios that I think will destabilize the economy a bit, particularly in crisis, and as a consequence, likely, unfortunately, in this case, help gold. I hope that wasn't too wordy an answer.
I think it's very helpful. There's a question here about gold and silver. Mile High Ed asks, hey, Rick, many are talking up gold and ignoring silver, while some are saying, forget gold and just go all in on silver. Why are most not talking about silver's potential, both long-term and short-term?
Silver, in my experience, has been more of a speculative instrument than gold. And silver tends to outperform gold towards the middle or the end of a precious metals bull market. In my experience, precious metals bull markets are led by gold because the first buyer is the fear buyer. Precious metals oscillates between greed and fear, with the fear buyer kicking off the move, and then the momentum established by the fear buyer bringing the greed buyer in. Silver, because I suspect of its lower unit cost, when the generalist money comes down into the precious metals space, that money eventually causes silver to outperform gold. And by the way, when the silver bull market starts, you're not going to need Rick Rule to tell you it's here. You're not going to see a move from 33 to 34. When silver moves, it really, truly moves. But normally that move takes a while to establish itself. And normally what establishes it is momentum in gold.
Back to the gold question, acquisition by central banks. Interesting question from Stephen Edmonds. Rick, with so much buying of physical gold by central banks for them to more likely than not never sell again, thus reducing the available float of available gold for sale, would you think this would eventually make gold price more volatile?
No, I don't. I don't believe that gold will never be sold again. I believe that gold will be a form of liquidity for central banks. And if gold does extremely well relative to fiat currencies, I suspect that many of the banks will need to access the liquidity of gold to fund politically expedient domestic spending programs. I understand the idea that as a position becomes more concentrated, that the price volatility among the remaining inventory on the market becomes more volatile. I would suggest that volatility will come into the gold space when you see the retail investor return to gold. What you've seen really for 3 or 4 years has been a predominance of central bank buying. Most months in the last 5 years, the flow of funds in terms of precious metals oriented ETFs has been negative, which is to say retail investors have been dishoarding gold at the same time that institutional investors, at least foreign central banks, have been hoarding gold. The exception to that, of course, would be the Chinese retail market, which has been consistent buyers of precious metals.
Rick, in planning an eventual exit strategy from silver, what would you suggest being a good target to use? Gold to silver ratio, or would you be looking for other factors to come into play?
The other factor for me is nebulous. What I do is I pretend the money's in cash, and I think about where I'd allocate it. Let's say that I bought a bunch of silver right now at $34 an ounce, and let's say 2 years from now it's at $50 an ounce. And let's say, just for fun, to make the math simple, I had 1,000 ounces. I look at the $50,000, and first of all, I look at the tax aspect of what it would cost me to get the $50,000. In other words, the capital gains tax from $34 to $50 an ounce. And I think what I would like to do with the remaining money. Is there an apartment building, a small apartment building that I could use to put a down payment on? Is there a stock that I think is substantially undervalued? In other words, the decision for me, at least on an annual basis, is what is the highest and best use of the resultant after-tax capital on every asset class I own, having observed these same governments now for over 60 years.
Steve P. asks, does Rick believe we will switch to a digital currency?
Over time, yes. What it will look like, I have no idea. My hope would be that we graduate to a plethora of digital currencies. I'm a consumer of currencies. I use the Australian dollar, the New Zealand dollar, the American dollar, the Canadian dollar, the Chilean peso. And to the extent that there's a whole bunch of smart geeks in some lab trying to design a better currency for me, I'm all for it. My suspicion is that the distributed ledger eventually will be a technology that's adopted really throughout commerce. I think, as an example, that home titles ultimately will be recorded and transferred on a digital ledger. And there's no reason why currencies shouldn't do that too. And there's no particular reason I can think of, other than the greed and larceny of host governments, that any issuer has a monopoly on a medium of exchange or store of value. And I would like, as an example myself, to be able to transact in fractional gold and silver. When I go to Starbucks to buy a cup of coffee, I'd like to have my account debited and their account credited for a fraction of a gram of gold in exchange for my coffee in the morning. And I think that will occur in my lifetime.
With the ever increasing probability that digital IDs and CBDC are on the horizon, which will probably be programmable, how can we use our metals to survive outside the system if liquidity isn't an option?
Well, the question becomes, how much liquidity in a crisis do you need? Let's assume that a bag of junk silver, as an example, when you went to acquire something with the silver, involved the merchant, because of a lack of liquidity, scalping you for 10% of the value of your silver, as opposed to having a digital bank, central bank digital currency, where the government canceled your currency altogether. Would you rather accept a 10 or 12% markdown, or would you be more comfortable with 100% markdown? The question is all arithmetic from my point of view.